Columbia's apartment market saw a nice bump in Q3, but fundamentals here remain underwhelming relative to what we've seen elsewhere in the Carolinas. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Columbia update. The Carolinas have been a regional hotspot for apartment performance over the last 5 years or so, thanks to good economic growth and ideal demographics in many of these markets. But despite being home to a major state university and a state capital, Columbia just hasn't ridden the same wave. And we've been saying that story for quite a while now. It continues to play out. And the baseline story just hasn't changed very much. Columbia is still an underperformer, but we did see some nice improvement in Q3, a seasonally strong period, of course, when students are returning for the fall semester. So let's look first at apartment occupancy rates, 50 basis points in Q3, following an even better 170 basis point jump in Q2. That brings occupancy up to 93.1%, and it marks only the second time since 2007 where occupancy got better than 93%. And we saw good demand pretty much across the product spectrum and across the submarkets over the past couple of quarters. But even at 93.1%, that's still among the weakest rates nationally, fifth worst among the core 100 metros, and among other markets in the Carolinas, the only other one in unspectacular shape is the Greensboro, Winston-Salem area, and you could see very healthy rates of 95, 96% everywhere else, even with a lot more supply to deal with in those spots. Rent growth in Columbia, generally limited, but again, some nice growth in Q3. Same-store rents for new leases jumped 2% quarter over quarter. But given previous cuts, rents are up only 2.1% year over year. And that's pretty much on par with the norms we've seen here over the last 4 years or so. And by that metric, Columbia doesn't compare as unfavorably to other markets in the Carolinas relative to what we saw in occupancy. Greensboro, Winston-Salem is a bit lower, and that's a pretty weak market in general. Raleigh-Durham is down under 2% as well, and that's almost entirely due to a huge supply wave in that market. Similar story in Charlotte, which is at 2.8%, but both of those markets are likely to see better numbers soon, and in fact are already seeing improvement. The top performers of late, though, have been the two South Carolina markets of Charleston, 3.7% growth, and Greenville, 4.9%. Both of which have better structural demand drivers than Columbia and should continue to be top-performing smaller markets even with a good bit of supply coming online. And demand drivers really explain why Columbia and Greensboro, Winston-Salem tend to be the laggards in the Carolinas. Among markets in those two states, only these two have failed to recover all the jobs lost in the recession. By comparison, the other spots have seen pretty good growth. And so we have seen some good numbers the past couple of quarters in Columbia. Can it continue? Well, we think this market is going to start leveling off again. Occupancy tends to be lower here. It's probably not going to get much higher. The one key spot, of course, is the downtown university area. We tend to see higher occupancy rates and better rent growth in that area. There will continue to be opportunity in that spot, but elsewhere there's probably limited upside, and that's going to hold down the market overall. And that wraps up for Columbia. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.